Hello, I'm James Milan with Arlington Public News, and welcome to Dollar Sense, a new series offered by Arlington Public News in conjunction with Platinum Wealth Partners, in which we will explore the world of finance in all of its myriad breadth and we hope depth as well. Helping us and guiding us through that is going to be Joe Camargo, who is a partner at Platinum Wealth Partners and a portfolio manager. Joe, thanks very much for taking this on.
Thank you very much for having me, James.
We could start just about anywhere
Okay.
talking about finance, but I figure let's start with something that everybody can relate to and everybody is familiar with.
Sure.
And I'll just pull out an example of what I'm talking about. This little piece of paper right here.
Right.
So tell me about that. It looks less like a piece of paper to me.
It's absolutely a piece of paper, and it's a very neat green piece of paper, multicolored in some areas. If you were to take this anywhere in the world, it has some value. And it has value because the U.S. government says that it does have value. What we operate on in our free market system is a currency that is called fiat currency. So this dollar bill is worth $1 in goods and services because the government says that it's worth $1 in goods and services. If you had pulled out a $20 bill, the $20 bill would represent $20 in value that you could exchange for milk, any commodity, any service that meets that $20 requirement. It is universally recognized as the primary currency in the world. There are other currencies, other countries that are very slowly, in some people's minds, catching up to the U.S. People talk about Japan and China, certainly, and you look at India also as a major potential market. But still, the U.S. with a $16 trillion GDP is far and away still the most important component to the global economic engine.
So it sounds like the dollar, our American currency, is in fact closely connected to and interrelated with the currencies of all these other markets. So if I'm going to take my dollar,
right,
and I want to go to Europe, I want to go to Paris, can I use my dollar on the streets of Paris?
Officially, what you would need to do is exchange our dollar for the euro or for wherever you are within the globe, and there is an established exchange rate for currency, whether it's the dollar to the euro, the dollar to the yen. So the value of the dollar is going to be driven very much so by not so much geopolitical conditions, but by the exchange rate that the countries have established for them, if that makes sense.
Yeah, sure. So it sounds like the dollar, our American currency, is in fact closely connected to and interrelated with the currencies of all these other markets.
Absolutely. We're in a very much a global economy. People still today look at things in a very regional, or with a very regional mindset. What happens in Europe, if Europe happens to sneeze, we catch a cold here in the U.S. and vice versa. So just lost my train of thought, but the dollar itself is going to have some value that, again, is predicated by
like how many euros it can get you,
right,
or how many yen
right,
it can get you,
yes,
etc.
Thank you.
No, that's fine. This stuff is hard to get one's mind around, even though it's part of the world that we're living in each and every day.
Again, and that's where I was going with my point. It is very much a global economy, and there are a lot of things working behind the scenes that most of us don't understand or aren't privy to. Perhaps down the road, maybe 50 years, 100 years from now, we're operating off of one global currency. That's certainly one theory. But right now, it is a series of currencies, all of which have different value during different periods of time.
Mm-hmm.
If that makes sense.
Sure. And given that that is the world in which we are living, what you said a little earlier that there is an established value for the dollar or for the exchange rate between the dollar and, let's say, the euro.
Mm-hmm.
how is that an established value? Who establishes that value, and how often does it change, et cetera?
$1 million question. It's a very loaded question, but essentially the markets establish the value of the individual currencies. There are mechanisms involved in the free market system that control the exchange rates. There are geopolitical conditions. There are economic cycles that change the actual value of the exchange rate, the dollar, the euro. I remember back in 2010, there was a great deal of concern involving the euro because it had lost so much value relative to the dollar. Now, 3 or 4 years later, it's not a concern. So things change, and things change in line with macroeconomic conditions, with the business cycle, with the economic cycle. So to give you I guess a finite definition in terms of what controls the value of the currency, it's a dynamic set of variables that control the individual currency, if that makes sense.
Yeah, absolutely it does. As far as anything does make sense, obviously, in this particular morass. But I also wanted to ask about. We hear quite often things referred to, or the dollar, for instance, referred to as being strong or weak, et cetera. Can you explain a little bit what that means?
Sure.
Because I'm sure it relates to these exchange rates.
Absolutely.
And then for the average American, is a strong dollar a good thing or a bad thing, et cetera?
Okay. Yes, the dollar, how do I explain this? The dollar is going to have periods where it's going to be relatively weak compared to another period of time. The strength of the dollar is going to have an impact on our exports, on our imports, on the overall state of economic growth, which is measured by GDP. So,
can I just interject?
Yeah, sure,
and
sure.
Just as a point of clarification, when we say strong dollar, are we saying basically that somebody would have to, if they were paying for a dollar in euros or yen, et cetera, they'd have to pay more of those dollars, of those euros, those currencies for a dollar?
For a dollar.
Okay, that's what makes the dollar strong. Go ahead.
All right. That was it. That's. Did that answer the question? I'm sorry if
yeah, again, just wondering then, if there's a strong dollar, if people are having to pay more euros for a dollar, is that good for me? Is that good for you?
Okay. So if I'm living in Europe, for example, and I'm looking to buy American goods, and the U.S. dollar is particularly strong, then I have lost purchasing power with my, in this case, euro.
A strong dollar is, in fact, not so good for us because we as depends on whether you're importing or exporting, right?
Right.
So if you have a strong currency, I believe, then that is better for exports and worse for imports.
Worse for import. And that is a somewhat counterintuitive way of looking at it. It's certainly, you would think that a strong dollar would be good in all instances, and yet it's not, because there's an inverse relationship between imports and exports. People frequently look at the dollar. There was a lot of talk for some time about the dollar being weak, and it was relative to the euro for some time. Now we've caught up, and the fact that the dollar has increased in value relative to where it was, say, a few years ago, is good, but it could also have a negative impact on our overall economic growth. If the dollar is too strong, then that is going to provide some headwinds for healthy net imports.
If I, as an American tourist, for instance, I'm going to go visit Paris again. I'm constantly going to Paris. Do I want a strong dollar or a weak dollar? considering that I'm going to go there with my dollars and I'm going to
You absolutely
trade
want a
those
strong
in for
dollar
euros.
because,
So-
yeah, absolutely. The exchange rate is something that excuse me, is always eyed on or looked at by the consuming public. So yes, a strong dollar is going to give you more bang for your buck relative to the currency that you're exchanging.
That's great.
Okay.
And by the same token, if I want to buy a European, I don't know, let's say European car, I assume that I would then want a weaker dollar. Is that right?
Because that's absolutely correct. Because the vehicle itself is denominated in
The euro.
Right? So that's where that inverse relationship comes into play.
Okay.
Right.
Thank you. That
Okay.
clarifies things for me, at least. Let's hope for our viewers as well. We've been talking a little bit about markets as they relate to currency.
Okay.
And I was wondering, can you tell us a little bit about, what is a market? When we talk
Sure.
about financial markets, are we talking about the same kind of thing on a different plane or with a different twist as our local farmers market?
Right.
Or
Right. In its very simplistic form, a market is a place, whether it's physical or somewhere up in the clouds, that allow for an exchange of a product, a good, or a service. You're always going to have a buyer, you'll always have a seller, and those individuals will meet and exchange their goods or services at a price that they deem fair, right? So if you take that very simplistic example and you broaden the whole concept of a financial market, when people typically talk about the markets, they're talking about the stock markets, right? I like to take a much broader view. When I talk about the markets, I'm talking about the capital markets, which is just a fancy way of saying, look, this is where one can put your capital. This is where one can exchange your capital. And it might involve the stock markets. It could involve the commodities markets, the bond markets, the foreign exchange markets, right? So
all of these investment vehicles, I just want to say, by the way, we will be discussing in
Yes.
future segments.
Right.
So we'll just allude to them now, but our viewers should rest assured that we will delve into and do our best to explain what we mean by these various markets more specifically. But again, talking about that concept of markets themselves, or a market itself, it sounds to me like what you're saying is basically any place where you have buyers and sellers, people who want and people who are willing to give up some good, some service, etc.
Correct.
You're going to be able to establish a market or find yourself in a market.
Yep. And just to kind of add to that point, you have the concept of supply and demand, which is going to drive the exchange rates, the price, right? For example. So when you talk about supply and demand, and I don't know if I'm getting too much ahead, but those are the two components that are going to drive, not necessarily the only two, but the primary two that are going to drive the price of the individual cog, good, whatever you want to call it. And so that cog, that good, is going to be, generally speaking, negotiated on between the buyer and the seller. The buyer is going to present his bid, the seller is going to present his ask, and when they meet at a point in which they both feel is fair, that's what's called your equilibrium price. If you have a price that is much too high, generally speaking, demand is going to fall. And once that price eventually gravitates down into an area where the buyers deem it fair, demand will increase. You'll see an exchange, and the function that the market is supposed to perform has in fact been performed. Right?
That was very clear.
Okay.
Appreciate
Good.
that. And actually, that does remind me that I'd like to swing back to our original conversation about money in this
Okay.
way. And that is, as you were just saying, you were bringing up supply and demand.
Right.
And right away that made me think, for whatever reason, about gold. And I assume that gold, as a good, is something that is in relatively short supply.
Correct.
And so therefore there's a relatively high demand for it. So it is a valuable commodity. It is a valuable good. Is that?
That's, historically speaking, that's true. But one of the things that I like to talk about when I talk to people about price and the value of the good that they're considering purchasing or holding, gold has historically been a strong flight to safety. When markets sell off, when the economy looks like it's starting to teeter into a recessionary period, people tend to gravitate towards gold because they think, the perception is that it has value, right? If I were to ask the average person what they thought about gold and how it performed in 2013, I think most people would still consider it a safe investment. And yet gold had its worst year in 3 decades. Its value plummeted by about 1/3. So for me, it's not so much about the physical commodity, the product itself. To go back to the point that you were alluding to, it has a lot to do with supply and demand. And if you see that demand for gold, for example, is starting to wane, and the price is starting to fall, then conversely you can make the argument that investors and individuals are looking at the overall macroeconomic environment as one that is improving, right? Because, for obvious reasons, I think. So right now I'm looking at gold as something that, if I'm an investor, I might want to stay away from. And obviously we're not here to make specific recommendations, but it all boils down to supply and demand. And as you opened with, the demand for that particular commodity, which is considered a precious metal, that has a relatively finite supply and much less so than other relative base metals and precious metals. It has higher value. But the value, again, is determined by that magical component called supply and demand.
And one takeaway from what you were just saying, it sounds like, is that if the price of gold is relatively low compared to where it can be, that may be a good sign that people are confident about the rest of the, as you say, the macroeconomic system.
Correct. Absolutely.
And interesting what you posed a little earlier about what if we asked somebody about the value of gold in 2013, because one of the things we'd like to do in this series is going to be going out and asking people provocative, interesting questions that we can then dissect in these conversations, I hope. And that you may have given us a very good idea for one of those that we can follow up on from here. I was going to say, though, that to get back to the dollar just before we close, my understanding is that a long time ago, at least, a dollar was the value of a dollar was represented by the proper proportion of gold, such that if you went to your bank, and we will be talking about the banking system in a future segment as well, if you went to your bank, theoretically at least, or there was a time when literally, I believe, you could walk in, hand over your paper dollars, and get the equivalent amount in these gold nuggets. Is that correct?
That's absolutely correct. And as you said, that was a long time ago.
How long ago was that?
Well, it depends on what point of view you're looking at. In the 1930s, Great Britain took itself off of the gold standard.
That was called the gold standard, right?
That was the gold standard. And as you said, for every dollar that you had on your person, you could theoretically go into a bank and exchange it for gold bullion, right? The problem that was presented, though, and there were some, but part of the problem was that there was not enough of the physical commodity to cover the amount of currency that was in the marketplace.
So there were more dollars than there was gold.
There were
to repay
absolutely.
those dollars.
And in addition to that, if you go back, most people understand that the Great Depression took place in the 1930s in that general area. One of the ways in which our central bank, which I'm sure we'll talk about as you mentioned a few minutes ago at a later date.
There's another topic.
Right?
Yeah.
The central bank has what's called the dual mandate. And the dual mandate involves price stability and full employment. And one of the measures that a central bank has at its disposal is to either expand the money supply or contract the money supply. Expand interest rates, lower interest rates. That's called both expansionary and contractionary monetary policy. So the problem with the gold standard, or again, one of the problems, was that because the dollar was tied to gold, and because gold had a finite supply available, the central bank could not go out there and print dollars, which is essentially what it's been doing over the last few years in an enormous amount. And that limited its ability to control the economic cycle and control interest rates and regulate the economy, which is really its mandate, right? Mm-hmm. So Great Britain was followed by FDR. FDR I think in 1933, if I'm not mistaken, took us off the gold standard unofficially. The gold standard still existed in a quasi-state for another 4 decades, and I believe we were officially taken off the gold standard in 1971, the early 1970s. I'm not sure of the exact date. Mm-hmm. So again, the desire to do that was driven largely by the lack of functionality or the lack of resources available to not just the U.S. central bank, but central banks across the globe. So I'll stop there, but that's just a precursor to, I'm sure, more discussions on that during the banking session.
Absolutely. Okay. But I guess, again, just as a final takeaway for our audience, don't think that you can walk into your bank and trade this for $1 worth of gold. It's not going to happen. Sorry about that. Right. Joe, thanks so much for beginning this series in such an auspicious way and really clarifying some of the knottier issues around money and currency and exchange rates, etc. Future programs will include explorations of banking and investment, different forms of investment, and all other kind of aspects of the world of finance. And we hope that you will be joining us for Arlington Public News and for Joe Camargo. I'm James Milan, and thanks for joining us for this inaugural segment of Dollar Cents.